Morning, guys. Good to see you both.
Good morning.
Morning, Carl.
Sam, in Star Trek, when they get hit by a laser and the captain calls Scotty and says, damage report, give me a damage report from Friday.
I'm doing the best I can. She's breaking up. Damage report is that I think that we got rebuffed by the 200-day moving average. We ended up with weaker than expected economic data. We then ended up with the Fed being more hawkish. So I believe we are now in the retest of the June 16th low. And so we're going to be seeing more pain, if you will, between now and the the September 21st Fed announcement. And, the question is, do we break to a new lower low, or does the June 16th low hold? And I believe the latter is the case.
Interesting. Stephen, what if jobs are weak on Friday? What if CPI is soft again next week?
Well, look, I think some more news like we've had on inflation will be very welcome by the Fed, but it's not sufficient. It probably will take some outright employment declines, and I don't think we'll see them until the new year to really turn the Fed around. It'll be the combination of falling inflation. Again, goods inflation has slowed from 12% to 7%. It still has that 12 months behind us, but it's headed in the right direction. Services take longer. It'll be 2023. But the labor market itself, again, the Federal Reserve said that it's not a monetary phenomenon that was really behind the supply shortages, but they're going to act as if it is. And I think you'll see some employment declines in the coming year. The Fed's going to be willing to tolerate a recession, and then it will reverse in the coming year.
That's interesting, Sam. To Stephen's point, prior to Jackson Hole, there was an element of the market that would welcome weak data because they believed it would lead to a pivot. But Powell's speech, just the framework of the speech now, seems to have given him a path to say, when weak data presents itself, to say, see, I told you, and it is part of the ongoing plan we have to be stubborn on hiking rates.
Well, I think you're right, and that Stephen is correct that we are likely to see the Fed remain sticky with their higher rates. Our expectation is 50 basis point increase in September, 225 basis point hikes for the remainder of the year, but then staying at that elevated level at least through 2023 and possibly into early 2024. So the pivot could end up being going from hiking to neutral rather than from hiking to easing.
Right. We mentioned a break even, Stephen, with Kramer in the last hour, the 1 year back below 230. That must be at least some silver lining in that things are not getting extended, embedded, getting away from the Fed.
There's a lot of good news here to suggest that this is a cyclical problem. As Chairman Powell said, we didn't have 15 years of failed attempts to lower the inflation rate. We've had inflation expectations long-term inflation expectations stay within a 1% range over the last 3 years, and we're still getting the largest annual rate hikes in history, along with QT. So the Federal Reserve is not acting as if this is going to be, again, a long-lasting inflation. It will, in every likelihood, be a recession, but the economy sort of didn't get to the top of the building. We don't have that far to fall if the elevator goes down.
Right.
I think, again, we didn't generate any of that hubris and denial about a recession like we had in 08, 09 or in 2000.